and get it started, team. Just really high level for the audience. We're excited to be here with you on the Alternatives to Venture Capital Fundraising. My name is Eduardo Zaldivar. I'm an early stage and late stage investor. I currently work for Clovis Point Capital, a technology private equity firm investing in companies between $3 and $15 million in revenue. And I have a great suite of panelists with me today. If we can just give us, team, a 1 to 2 minute high level on yourself, as well as the organization that you work for. And if you don't mind starting us off, Natalie.
Perfect. Thank you, Eduardo. Good morning, everyone. My name is Natalie Mojica. I am a business advisor for a women's business center that is hosted by a local microlender CDFI called Lift Fund. A little bit more about Lift Fund. Lift Fund has been providing support for business owners in the form of capital and also education for over 25 years. We are one of the largest microlenders. A microlender is a nonprofit organization that provides capital to startup and existing businesses. We've been around for a while. Our base our home is Texas. We have our own loan programs, but we also work and play under some of the SBA programs for businesses. So that's just a little bit about me and a little bit about Lift Fund. Thank you.
Thank you, Natalie. Appreciate that. Cheryl, do you want to give us the high level?
Yeah, thank you guys, everyone. I'm super excited to be here. Wish I was in Dallas right now, though. So my name is Cheryl Campos. I'm a director of growth and partnerships at Republic. Republic is a spin out of AngelList that allows anyone to invest in startups and for startups to raise up to $1 million. So actually, hopefully in the next 1 to 2 months, that will change to about $5 million. And crossing my fingers, yeah. And so that will allow startups to raise more money from people around the world and also fill their full round. So it'd be pretty interesting. So we have about 700,000 investors on the platform. We've helped over 150 companies raise over 50 million now in the past 3 to 4 years. And we're just getting started. So I'm always excited to meet new founders and kind of tell them our great stats, right? 40% of our founders are women, 28% are Black and Latinx. They hail from over 30 states. I'm trying to get to the 50. So also crossing my fingers for that. And yeah, we're really putting the word out there. So super excited to also have Eduardo as a venture partner for Dallas and trying to support with getting the Dallas ecosystem plugged in with Republic as well.
Awesome. Thank you, Cheryl. Cheryl's being humble. Republic is doing some incredible things, team. If you haven't checked out Republic.co, please do so. An incredible platform that's totally upending the venture capital model and democratizing access to startups as an investor, but also as a founder to fundraising. So appreciate that, Cheryl. Clifton, do you mind giving us the high level?
Sure. Cliff Colbert, wear 2 hats, banker with JP Morgan for technology, and today I'm going to focus on the other hat, which is with the Defense Innovation Unit. We are a group headquartered out of the Pentagon that's focused on adapting dual-use technology that's typically commercial but has the Department of Defense applications. And I think probably one exciting thing to think about is, as you think about the Department of Defense as an end customer, it doesn't necessarily need to be weapons and airplanes and vehicles. There's a lot of things that are happening around the world that makes us either less or more competitive with our adversaries. And so happy to talk about different ways to do business with the overall department today and kind of some of the things that we're focused on. So good to be here with you, Ed.
Awesome. Thank you, Clifton. Appreciate it. Vic?
Yeah, Vic Thopper with Cypress Growth Capital based here in good old Dallas, Texas. We're a traditional fund. We're investing out of a $42 million fund. We invest in predominantly SaaS and tech-enabled services businesses, all B2B. Our check size is $1 to $5 million. We've made close to 40 investments across our 3 funds. The way we invest is a little different. We're investing in entrepreneurs that really value their equity, really think what they have is a home run, and giving up equity, especially early on, is something that they are not interested in. So we'll invest, and instead of taking an equity position, they'll pay us a monthly royalty until a cap is hit. Once that cap is hit, the obligation is over. All of our backgrounds at our firm is in tech, so we are doing the things that an equity investor would do, like strategy sessions and things of that nature. but the entrepreneur keeps their equity, keeps their control. So it's sort of best of both worlds is sort of how we look at it. So yeah, that's a little bit about us.
Appreciate that, Vic. I think I've known Vic for a little while now, and if you're a founder that's looking for founder-friendly funding, it's really hard to beat what Vic is doing over at Cypress. So we appreciate that, Vic. Team, we'll appreciate you all being here. I think I want to start off with just the most informative piece that we have 91 people here listening in. And if they're here on this particular panel, that means they're looking for some alternatives to fundraising from VCs. I just want to hit the most direct question first. What type, and I would love for each of you to answer, what type of founder or company is most conducive to your funding model? And then on the flip side of that, what type of founders or companies just aren't a good fit? Doesn't mean they're a bad company, but for what you're trying to do, it might not be a good fit. So I'd love for us to each answer both sides of that coin. We can go in that same order. Natalie, we'd love for you to start us off.
Great. And I will share a little bit more about the ideal customer for Lift Fund. Again, high level, but Lift Fund works with individuals or business owners who are having a hard time obtaining funding in other places, right? Other places is really broad. It can mean a traditional bank. It can be, right, investors. Lift Fund, that's what Lift Fund does. The majority of our borrowers are underserved borrowers, minorities, Black, Latinx, women-owned businesses, veteran-owned businesses, and we also do work with startups. So these are startups under 2 years, and I will share that the majority of Lift Fund's programs are debt-related. So it's a loan. We don't take equity in the business. It's a loan that you take out and you pay, Lift Fund back over a certain amount of time. But that's just a little bit more about the, high-level overview of an idea of what type of borrower Lift Fund is looking with, or what type of founder business Lift Fund works with.
Thank you guys. Yep. Sorry about that. Guys, FYI, if you have any questions during the entire panel, please make sure to put them in the chat. I love responding to things. I will probably send you guys all links at some point too. So, so Tisha's, I'm with Republic. So just as a reminder, guys, we're spin out of AngelList. We allow anyone to invest in startups. I will actually put this link of the companies that we currently have on the platform so that you guys see a little bit about what I'm talking about right now. So in terms of companies that we want to service, we service anyone from pre-C through Series B, right? We actually have a company right now that is raising their Series B, 18 million from Greycroft, Lera Hippo, all of those, but are using Republic to actually market their product, which is a very interesting use case. So for the most part, though, our sweet spot is anywhere from C to Series A. We look for companies that are U.S. incorporated, companies that are post-product, post-revenue. So if you're pre-revenue, there are very specific limitations, but you can always reach out to me if you are curious. We're industry agnostic, which is pretty awesome. So we do have a motley assortment of different companies. And I think at the end of the day, what we really want is a company at the right position to use this as both a fundraising source to raise up to $1 million, but also as a marketing tool so that they have a good customer base that they're able to leverage this campaign to engage their customers, acquire new customers, really create lifelong brand evangelists that we be around them and have a financial stake in their success, because then they'll tell their friends, they'll tell their families, they'll buy the product, and then they'll make sure that everyone has a product around them. So I think that's something that we've seen time and time again really be a great result of the campaign. There's a company that raised almost $1 million just customer pipeline from one person. And I can put more stats on that in the chat.
That's helpful, Cheryl. We appreciate that. It sounds like, all kinds of companies can raise on Republic, but those who have a consumer side oftentimes just kind of see this boost because of the evangelists. That's not to say that B2B can't be on the platform, but it sounds like you've kind of seen that work especially well.
Yes, actually, clarify on that. B2B actually performs the same, if not a little better than B2C, simply because our investors are more sophisticated than we give them credit for, because they see this as an investment opportunity. Remember, it's not just about giving your money to something you believe in. It's about making sure that this is something that actually, does get a financial return. And so,
Right.
yeah, that's something that's really interesting to see, and we're probably going to continue to see.
Awesome. Appreciate that, Cheryl. Clifton, what about yourself? Give us the kind of profile of ideal entrepreneur or startup that works with the DIU specifically.
For sure. Yeah. DIU is more solicitation based. So we found, DIU, we're probably on the fourth iteration of our organization, but 1.0 was more of us selling really cool technology into the department. And we found that we needed an end customer to actually own that technology, because these contract vehicles are extremely significant in nature. And so we started working backwards, and we worked with our end customers, being Army, Navy, Air Force, et cetera, to actually define dollars around a problem set. And then we go back out to the commercial world through a solicitation. And so the easiest way to be in the know is, stay tuned to our website and see those solicitations. There's 5 focus areas across what we're looking for. We're getting ready to launch a 6th, actually, focused on advanced materials and energy, along with cyber and some of the other ones that we're focused on. But essentially, we write anywhere between $1 to $5 million checks, and we fund the dating period. And so that's kind of, there's a prototype period that we will pay for and help pay for with the end customer, hoping that it goes into a follow-on production contract, which is the ones that you read about in the newspaper that are extremely significant in dollar amount. So when you think about us, we're trying to adapt commercial technology for the use of the department. So think of it as an entrepreneur, when you should think about it as, if you already have a viable product and customers, and you're thinking about expanding into a new industry, whether that's healthcare or whether that's travel and entertainment, we want you to think of defense as being another industry that your company participates in. And we're here to help bridge that gap on how to do that. And so that's the things that we're focused on over at DIU.
That makes a lot of sense. Appreciate that, Clifton. Vic, what about yourself? Tell us about maybe some of the profiles that you've seen come by and do especially well with Cypress.
Yeah, so you have the basics where we're investing in B2B companies, sort of $2 million in revenue and up. Break evenish to a little bit of a burn. So those are basic things, but that just sort of maybe initially vets you. But we're at the end of the day, we're betting on the people. That's who's really going to scale the business. Not necessarily our capital. Our capital is going to help that, but we're betting on the management team. So that may get you in the door, the revenue, what you're doing, et cetera. But we're looking for entrepreneurs that are obviously really believe in themselves. They're able to attract A talent around them. You may have an A CEO, but you have an A+ CEO that has the ability to bring people around you and retain them. Because that A CEO can only take you so far. The team is what really gets you, I would say past 5-6 million in revenue. If you just have that one person management team, they'll probably cap out at 4, 5, 6 million. In my opinion, and what we've seen in the past. But we're looking for folks that we really believe in. They have the unit economics down. They know if they put $1 into sales and marketing, that they have the ability to go to $3 or $4 or $5 coming out of it. So they're coming out of startup, right? They are not a startup anymore. It's not a startup risk. It's more of a scaling risk. And obviously, the management team at the end of the day is what can scale the business. So that hopefully that answers your question, but it's highly subjective. But those key factors, B2B, the revenue, get you in the door, but the management team, the CEO, CFO, et cetera, are the ones that really get an investment, at least from our standpoint.
Right. No, that makes a lot of sense. Appreciate that context. It's really helpful. I think people in the crowd are beginning to see a little bit more where they might fit in, whether it's Lyft Fund, Cypress, Republic, the DIU. So that's really helpful panel. I appreciate that. Just couple of follow-up questions specifically for each of the panelists. Cheryl, obviously Republic has funded now a large number of companies. There's a fairly large data set on what the company looks like trajectory-wise. There's something in VC that we often call signaling risk. This idea of how does previous funding and the perception of previous funding affect your ability to raise in the future? Can you tell us a little bit about how maybe traditional venture capital firms or other investors, say private equity, view a startup that has raised crowdfunded equity? Is that something you've seen as be a signal risk? Has that been a positive? Just give us a high level on what an entrepreneur can expect in terms of perception.
Yep. Wonderful question, because we get that a lot. People, I think when we came onto the scene, people I think especially VCs say like, oh, we love disruption, we love startups to disrupt, and yet when we actually do it for their own space, they're like, oh no, actually this is not what we meant. So, so that being said, we did have to fight an uphill battle, right, in terms of trying to get accepted into the community as a viable source. That also meant that we had to really focus on, as this is a platform, on the supply side. So getting as many great companies as we could to really believe in this, what we were doing, and then actually go and raise on Republic. So what was amazing to see too was that COVID, even though, definitely disrupted a lot, and actually, Silicon Valley slowed down significantly for a little bit, that actually presented an opportunity for us to come into the scene and actually become the bells of the ball. So then people all of a sudden were asking the question of like, where else do we go besides VC? And we were out here like, we've been here the whole time. Like, can you love us? Thank you. So I think, what was it, like 27 panels, like that quarter, just spreading the word about what we were up to, because quite frankly, people before weren't giving us the time of day, and yet now they really see the value that it is. I mean, there's so much space in the capital continuum, right, where all of these different capital sources can live, and yet people just always see the VCs, right, because there's like, I think, great branding there, right? In terms of the VCs, before they were a lot more like, what does this mean? A lot more inquisitive, but now they actually see that it's both a complement and an alternative. 75% of our companies have actually raised on average 1.5 million from VCs already before coming onto the platform.
Oh, wow.
Right? Yeah, exactly. And so, having now Kangaroo, a Series B company with 18 million backed by leading VCs, gives us credibility. It gives us that sense that, like, there are companies that might be bootstrapped but still raised on Republic, which is great because they're trying to mobilize their community. But at the same time, there are also VC-backed companies that are using this to top off their round, to get a bridge round, so we definitely have been fighting the good fight, but now it's our time to really see our acceptance in the community, and so we're super proud of that.
I love that. Appreciate that, Cheryl. It sounds like maybe at a certain point in time there was some risk, or at least some perception of risk around that, but I think it's increasingly becoming the opposite of an issue, a benefit, especially when you look at Republic and the home runs they've had this far. So I appreciate that context. And just to pivot a little bit, Natalie, on the Lift Fund side, obviously, as you mentioned, we're talking with companies from the Lift Fund that maybe are not ready, not quote unquote bank ready. Can you talk to us a little bit about how Lift Fund evaluates? What is the evaluation process? What is the due diligence process for Lift Fund, in that it's going to be, as I can imagine at least, different from how a bank would look at it?
Great question. So again, like I mentioned earlier, Lift Fund, the way that we provide capital is through the form of debt, right? A loan that you get and you pay back over a certain amount of time. How we differ from traditional banks in the way that we look at things. We do love banks because banks allow, they're partners of us, right, by providing capital for us to be able to do what we do, but then also providing referrals. So we work really closely with the banks, but the way we're able to be a little bit more flexible in the way that we review kind of happens in these couple of ways. So we don't have like a minimum credit score, right? So we are looking at people's credit for that. We can work with startups that aren't like at the 3-year mark. So even people who have ideas that just need some startup capital to get going, we can do that. The use of our fund is pretty open as long as you're using it for the business. So we're not too, marketing, working capital. And then again, since we're kind of working on the, loan debt side, we're looking at things differently maybe than some of the other capital programs. But, we can be a little bit more flexible, again, how we're reviewing credit, but then also collateral, right? We can look at stuff within the business, stuff on the personal side. That's just how Lift Fund differs a little bit from some of the traditional banks, and how we're able to say yes a little bit more just because of how we look at things.
Absolutely. And just two quick follow-ups that came in the chat. Can you elaborate? Andrew Chalk said, what is collateral? Can you elaborate about what you mean by that?
Yeah, so simply put, collateral are assets of value within the business or personal. So to make that a clear example, so within the business, maybe you have, right, desk, your computer, your laptop, things
Right.
like that. On the personal side, maybe you have a car that's free and clear. That's a very high level overview of that. What I will say is, Lyft Fund does look at that, and we're going to ask that question. And there are programs available that if maybe you don't have a lot of collateral, right? Because some businesses, right, especially within the tech space, don't have a lot of collateral.
Right, pretty lean.
And we look at other things that kind of might be outside of the business to see if we can, find things like that. But simply put, collateral, just assets of value within the business or personal that we can, we just kind of take a lien on them. And if you don't pay the loan, we will collect on them. But if all goes well, we don't bother the collateral. We don't want the collateral.
Right. No, that's super helpful. Appreciate the clarification, Natalie. And Clifton, just on the DUI side, it being a government-backed, Pentagon-based organization initiative, I imagine there's some misconceptions about what you might do. On my side, I'm kind of thinking, is it only space tech, space shuttle tech that the DIU is funding? Can you maybe talk through us some misconceptions that people may have just hearing the backing of DIU and what reality is actually?
Yeah. So DIU's capital is non-dilutive, and so it's structured as a contracting vehicle. And so that's one thing to remember, is that we're not taking equity or maintaining a position in the company. Kind of going back to that first point, we're funding the dating period. So all of our focus is really on the end customer and making sure they have the capability needed to be competitive in whatever environment that they're in. And so we have 5 focus areas. Cybersecurity is one, space is another, human systems, AI, machine learning, and then autonomy, and then energy's launching later this year. And so I'll break down maybe like space, for example. So space has been really.
We had a question about space in the chat, so this would be really helpful.
Yeah, so our end customer has primarily hardware problems, but software does come into play in a lot of cases, especially around cyber and even space when you think about low Earth orbit and things that are going on. And you can read a million articles out there on the race that's happening in low Earth orbit and satellite real estate. And so we're highly focused on making sure we're equipping the ecosystem from a communications perspective more than a hardware A to B, how to get into space, necessarily. Not to say that we won't, but the end customer is what's essentially driving that. And so as we look to build out what entrepreneurs and how they interact with the universe that we deal with from a department perspective, it's really focused on kind of those 2 things. You can have that emerging idea, and I see somebody's talking about healthcare and B2B SaaS, and so 2 things to keep in mind is not just what problem is the technology solving and how can you scale, because the scale of what we're dealing with at the end customer becomes really important. And a lot of times we're the ones, brokering relationships with the primes, the Lockheeds, the Raytheons, Northrop Grumman's of the world to make sure those startups can scale. And so being open to, having the department as an end customer in a major way, also, leads to opportunities to partner with other organizations that can help you get there. And so that's kind of the concept we're thinking of. So some of the projects we're doing, predictive maintenance is one. DIU is really on the right side of the scale for department-wide effect projects. So when you think about us, think about programs of record. Predictive maintenance goes across every aircraft in the entire Department of Defense. So Air Force, the Air Force, Army, Navy, et cetera. And then there's also other innovations, sales that are within the department. So I would be remiss if I didn't mention, the AFWorks of the world, which has a, SBIR process with small business innovation research. DARPA is actively funding ideas for people. Army Futures Command down in Austin does a really nice job with a focused problem set. And so there's different people that are doing different functions. But DIU is really focused on things that are going to change the entire Department of Defense, whether it's a small startup or a company at scale.
Right. No, it's great to hear some of the, I think it's easy to pigeonhole what the government funds in one place, but it's great to hear that DIU is really spread across a couple of different industries. That's really helpful. If you ever need a volunteer out for an astronaut, space and soldier, sign me up. I will quit my job tomorrow. Appreciate that, Clifton. That's super helpful. Vic, on your side, you mentioned, very founder friendly. I'd love to hear maybe how do you think about partnering with more traditional funders, whether it's private equity, venture capital, banks, how do you work alongside the institutions if you do at all? What does that relationship look like?
Yeah, so great question. So we collaborate with senior lenders all the time. So sometimes there's not a senior lender because we're coming in. There's the capability of a senior lender coming in. Sometimes they're already there, but we collaborate with essentially all banks. We always sit behind them from a subordination standpoint. So that's never been an issue. Most of our companies have been, seed funded by angels or family offices. They're not the 10, 15 million in equity raised from like a California company would be. Ours are the way our entrepreneurs' thought process is, I'm going to raise some money, get off the ground, and try to raise very little for the foreseeable future. At least raise very little in dilutive financing for the foreseeable future, and then go raise a growth equity round. So we're a great feeder into growth equity. So I would say if you had to classify us, we're more of an alternative to Series A, I guess if you wanted to put it to anything. So we'll come in 1 to 5 million as an alternative to equity, and then the company takes our capital, grows, and 80% of our companies will get one of three things: bought by a private equity firm. Number 2 is get bought by a strategic, or number 3, raise a significant growth equity round. So in our minds, that's north of 5 million. And they've used us, so the valuation obviously increased. The dilution obviously is less impactful. The control provisions are less impactful. So that's sort of where we fit in. We're very, growth equity loves us because what are they investing in? They're investing in the equity. And if an entrepreneur has done whatever they can to avoid dilution, that really tells them what this entrepreneur thinks their company is eventually going to be worth. I mean, and then they've taken our capital and grown from 4 million to 10 million. So they know this entrepreneur can take capital and really reap the rewards, right? They can really put money into marketing and spit out, significant growth. So we have growth equity conversations all the time just because we're a great feeder into it.
Right. That makes sense. It sounds like it's not a contentious relationship. It's the opposite. They want to work well together, and they want to bring Cypress along as well. That's very helpful. Appreciate that, Vic. And a question for a more general panel. We had a question from the audience. Trevor Atkins asked something around the asymmetric shock of COVID-19. I do want to hear at a high level, how has COVID-19 and the associated economic situation affected your type of financing specifically? Obviously, VCs are affected in a certain way. Private equity, where I work, is, we were a little bit more cautious at the beginning, but now we're seeing some opportunities. Can you talk to us, each of you, maybe give me a 1 minute to 90 seconds high level on how has COVID-19 affected the funding that you do, if at all? We can start again with that same order. Natalie, we'd love to hear from you first.
Sorry for the background noise. For Lift
No worries.
Fund, for Lift Fund, we, for the past couple of months, the way COVID affected the work that we do and how we support business owners through, loans and getting them that funding that they need to get started or grow, we, for the last couple of months, put a pause on some of our regular programming, meaning, for example, if I was being approached by a lot of small business owners a month ago about people are starting businesses, right? Even though through the pandemic, or it's created a need for people to start businesses. So we put a pause on some of for example, our startup programs, and we started to work on specific loan or grant programs that were, we were getting through local cities, local, counties. For example, in Dallas, we were working on a program called the Revive Dallas Fund. And that's something that we're partnering with Dallas Entrepreneur Center, the DEC, and then also Communities Foundation of Texas. So short answer is it put a pause on a lot of our regular programming, and we took somewhat of a shift to really funding loans and grants to existing businesses that had been affected by COVID. But things are slowly starting to open back up. So those conversations can be had now.
Great. And it sounds like you've been, cautious, not completely out of the game, but you've been monitoring the situation and being abreast of how it's changing over time. So that's really helpful to know that Lift Fund is, still in operation, hasn't ceased funding. That's helpful. Cheryl, how does Republic approach, COVID-19? Have you seen an increase in acceptances, a decrease? Give me the reaction.
Oh, God. I mean, it's been our time, which is awesome, right? As I mentioned, we are a virtual platform, right? The only thing that was really disrupted was kind of our New York headquarters, right? We just became remote, but that also meant because Silicon Valley was slowed down, we had an influx. I think it was like 3x the amount of applications that we generally get. And by the way, last year we got 5,000 applications. So you kind of already can see how much demand we were in.
Wow.
And so, yeah, we technically have a less than 1% acceptance rate, which is kind of crazy because, if you had asked me like 2-3 years ago, I would have been like, apply, and now it's a little bit more about, okay, we are the most curated of all the platforms, right? And so we really do want to put the best companies that we can find to really give that opportunity to our investor base as well. I think we also just have a really good due diligence process because we've seen so many, so we're now okay, like this is what's going to fit and work with what we offer. And so so that being said, our investments on the platform decreased a little bit during COVID, but then they shot right back up. So I think people were kind of at first a little bit stressed about what COVID means, but then they realized that, especially because the public markets right now are, I don't know if you can predict them, but I clearly can. So people are trying to take their money away and are trying to diversify their portfolio. And so they see Republic as another way to do just that. So on both sides, both on the company side, with finding great companies, we definitely have a lot right now in the pipeline. And then on the investment side of the platform, we're seeing people actually invest more and more. So crossing my fingers that this continues.
I love that. It sounds like in a lot of ways for Republic in their model and who they look for, it's been more of a tailwind than it's been a stopgap. So that is incredible to hear. I love that, especially I'm sure with the Republic Note launch and the innovations there. This is just a great time once again to be working with Republic. Appreciate that, Cheryl. Clifton, how about yourself? Being in the government, is that affecting funding? What does that look like for the DIU to be actively investing during COVID-19?
For sure. Yeah, I think our funding cycle is more governed by the fiscal year policies that you see from politics more than COVID-19. And so I think we haven't seen it go down in direct correlation with COVID because, it's more about being in alignment with those solicitations and active problem sets that are being solved. And so when we sit down at the beginning of the fiscal year, we set out what focus areas are going to be solved for. And so that's kind of the thing. And so on one hand, it's really hard to get something done in our group that is not within those 5 focus areas that I spoke about before. But those are problems the government would solve yesterday if they could, right? And so they're actively committed hours to get those things done as soon as possible. Yeah,
that's really helpful. It sounds like it's there's some level of stability with the fiscal government year versus maybe a sudden macroeconomic event. So that's really helpful to know where DUI stands and how that looks like.
Yeah, so when there's gravity, it's a strong gravity, right? It's something that is an actual need, not necessarily a want. It's a need that somebody is waiting for, and so we try to we move fast and we fund fast.
That makes a lot of sense. Appreciate that, Clifton. Vic, what about yourself? How have you seen the more royalty-based financing evolve in the era of COVID-19? Is that affecting you at all? What does that look like?
Yeah, so when COVID first hit in March, given our tech background, is help our companies, right? We have 17 active portfolio companies, so we share best practices amongst each other. There was a lot of government programs like the PPP and the IDIL and the Main Street program, et cetera. So we were just relaying everything to everybody because it was very confusing, and it was changing obviously day by day. So that's what we first did, and most of our companies did qualify and get PPP funding. Given what's going on in the world and how you just don't know, raising equity is even more dilutive right now than before. So we've actually stayed pretty busy. I guess to step back, of our 17 companies, 2 have gotten bought in the last 60 days and 2 have raised growth equity rounds. So that in itself tells you a little bit about the market, how active it is generally speaking. And then we have been extremely busy because equity investors right now, because of the uncertainty, need to factor that in when they're thinking about valuations, et cetera. Rightfully so, in my opinion. And so we've become an even busier investment fund because we're non-dilutive. So instead of giving up more equity now than before, using us and then going to an equity round, like I previously stated. So we've maintained, we've stayed pretty busy. We have 3 term sheets out right now, so pretty active. The only problem is that we can't go and meet entrepreneurs,
Right.
not in Dallas, right? We want to meet every entrepreneur, not for only for our benefit, for theirs. They need to know who their long-term partner is going to be, and we think it's important for them to do that. That's the one thing we're struggling with, is how do we do that? In Dallas, if you're here, we can easily do that. But getting on a plane, getting into a hotel, and doing those types of things, everybody's tolerance level is very different, which we totally understand. So that's the only thing we're trying to get our head around. And I think, honestly, we'll just have to do that later rather than sooner. So we may have to make an investment via meetings, Zoom meetings, and things like that. And then when it's safe to travel, start meeting folks.
Yeah, no, I appreciate that. I think many of us are in that same boat. It is a little bit weird. My firm is currently in the process of closing our first fully virtual deal. And so it is definitely a different era, but I think we're seeing a lot of firms, I think everyone on this call, adapting to the needs of the situation. And at the end of the day, entrepreneurs, founders still need our support, still need our funds, and we're happy to adapt to what they might need. So we appreciate that perspective, Vic. And we have maybe time for one more question here and I'd love for the entire panel to answer this. I think there's a lot of uncertainty as it relates to fundraising in the future. We're seeing the AngelList rolling funds. We're just seeing a lot of innovation in the fundraising space. I would love to hear everyone give me maybe their 1 minute, maybe 2 minutes. How do you see your type of fundraising changing, evolving, adapting in the next 5 years? Give us that. In 5 years, I see Republic doing this, Cypress this, whatever it might look like. Give me the 5-year perspective on how your organization does funding. Natalie, we'd love for you to kick us off.
Great. Good question to kind of wrap us all up. So, over the last couple of months, Lyft Fund has been playing a lot in the space of grants, right? So business grants, where you get some capital for your business, some money for your business, but you don't need to necessarily pay it back, right? So for Lyft Fund, that wasn't the case for us. Like before COVID, the majority of our funding was debt. It was a loan you had to pay back. But because of the nature of COVID, the partnerships we've built, we just have been able to get some funding to be able to offer this kind of free money, right? No strings attached for business owners. So for Lyft Fund, I think we're going to start now playing in that space as well a little more, but continue to do what we've been doing for over 25 years, right? Some loans to get you going, growing the business. So that's what I'd say what might look like for Lyft Fund over the next couple of months and maybe the next couple of years.
Awesome. So on the Republic side,
appreciate that.
We have a ton of aspirations, right? We want to be the Amazon for private investing, right? My idea of that is that you go to a store, you see a great new brand, you eat the brand, and you're like, oh my God, this is the best thing since sliced bread. So you just go on Republic, you invest in the company, and now you are their customer for life. Right. There are so many times where I've had brands where I'm just kind of like, how can I invest in you? And that's actually how I've been able to cold outreach to some brands, and they actually ended up on the platform. So it works out. And so for me, I really want that to be the case where we don't have 700,000 investors. We have 700 million. Right. And so I think it's really about harnessing that power in numbers where, drops fill the bucket. Right. It is all about bringing people together to invest in startups. And my dream would be for startups to go on the platform. People had been waiting for the opportunity, and then they just raised the full $1 million in seconds. Right. That would be amazing for both the startups, but then also for people who have the opportunity. And we also want to make sure that we remain intentional, right? We're already kind of seeing that we are moving towards upstream, right? From pre-seed, seed to now seed and Series A, just because of the amount of companies that we are looking at. And so, but that also means that our stats are getting worse and worse in terms of diversity and in terms of inclusion, right? We want to make sure that we stay intentional, which is why we have the Venture Partner Program, right? This is why we have the Republic Cities initiatives where we actually go to these cities pre-COVID. And so that being said, we want to make sure that we have these stats the 40% women founders, 20% Black and Latinx, to continue to really. And so anyway, so the point is that we actually have a couple initiatives coming up. So Eduardo, you'll you'll know about them first, but it's super exciting, and we're hoping to really make an impact there.
Appreciate that, Cheryl. And just a quick plug of Republic, we are working on a partnership between Republic and the city of Dallas. So if you are a startup hoping to raise from Republic, please reach out to both Cheryl and myself, and we'll get you plugged in with the initiative that we're working on. It's still a little bit under wraps, so bear with us, but we're really excited about what Republic is doing and how it's going to partner with the city of Dallas specifically. Appreciate that, Cheryl. That's really helpful. Because then what about yourself? What does the next couple of years look like for the DIU?
For sure. Yeah, I think you'll see us expand into a couple different that really fit the kind of the end state. And then I think you'll see a little bit more partnership in the, from the commercial investment community. We've primarily funded mainly from our pool of capital, but I think going forward over the next 5 years, you'll see some solutions that'll help, bridge companies in a way that when it does come time to scale, we're actually helping making those connections as well, so that it's not just about living under a prime contract with somebody that's already a part of the industrial complex. We will continue to partner with them, but I think we'll try to expand our universe of investment partners for the companies that we work with.
Great. That's really helpful. I do think it's DUI is incredibly innovative, and I think we're going to over time begin to see more and more of the successes that come from that initiative. So we're very excited about that. Appreciate that, Clifton. Vic, what about yourself? Next couple of years, you're one of the only royalty-based financiers in Dallas. How do you see the next 5 years kind of evolving for the type of funding that you do?
Yeah, I think we've already seen it. We've been around for 10 years, and we've already seen our way of investing become more and more popular. We've been the most, active, I would say, given our check size. And then, we're just going to continue our approach. We'll probably be a little bit more creative, add a little, more things to it. But we'll go raise Fund 4 in Q1 of next year. So our last fund was $42 million. So we'll go raise our fourth fund in Q1, which will probably be, 50-ish million revenue, 50-ish million fund size. And we'll just be continuing to go to market. But we will be making some enhancements. And we're in the early stages of, internal discussions on that front, but we continue to see our way of investing being extremely popular.
Yeah, no, I completely agree. I think over time we're evolving to just additional competition in the fundraising world. I think that is a good thing for founders, and I think for those investors who are willing to adapt, that is a really good thing as well. Appreciate that, Vic. We are right at 10:43, and as some of you may know, Hopin actually kicks you out automatically after like 45, so I think we're right on time. Team, thank you so much for being here, panelists. We really do appreciate your support of the Dallas ecosystem, of the founders of Dallas. I think in this time in particular, we want to be here for our entrepreneurs, and I think we're doing that. So appreciate your time. Audience, if you have any burning questions, I know we weren't able to get to all of them, but we really do appreciate you being here. First, I'll say I am very comfortable saying I think anyone on this panel would be happy to connect with you, so feel free to reach out to them on LinkedIn. I know a couple of them have shot their emails in the chat. Please feel free to follow up with more point-specific questions there. Two, these sessions are being recorded. So over the next couple of days, I would imagine sometime in the next 1 to 2 weeks, we'll have all the sessions recorded and released, likely on the Dallas Startup Week website. So please make sure to follow the Dallas Startup Week site on LinkedIn, and specifically the DEC Network page on LinkedIn as well. So once again, panelists, appreciate all of your time. We have another panel coming up at 11 a.m. So in about 15 minutes, it's Women Investing in Women. So we'd love to see you there. Panelists, thank you again.
Have a wonderful rest of your day.
Bye.
Bye, guys.
Bye.